Today is the 11th of July 2022. My name is David Hickson, and in today's market update we're going to be taking a look at gold. While you read and make sure that you have understood these disclaimers, I'm going to apologize for the sound of the cicadas. I'm in Italy, it is pretty hot at the moment, and those cicadas are making a lot of noise which seems to penetrate all of my soundproofing, so I apologize for that sound. Hopefully it is not too distracting. Now that you have read the disclaimers, let's take a look at gold. This is the analysis that we've been looking at for some time in gold. Of course, the important points about this analysis are the fact that we witnessed an 18-month cycle peak that was in March of this year. I've discussed previously the fact that we have a dual analysis on this chart. There are in fact two analyses. They are separate analyses. At the foot of the chart is a trough-based analysis. In other words, an analysis that is performed on the basis that the cycles that are influencing price are synchronized at their troughs, which is of course the principle of synchronicity, one of the fundamental principles that Hurst discovered 50 years ago. But there is also a second analysis on this chart, which is plotted at the top of the chart, which makes the assumption that the cycles that are influencing the price are synchronized at their peaks. It is mathematically impossible for both of these things to be true. If the cycles are synchronized at their troughs, they cannot be synchronized at their peaks. However, I should point out that there is some subtlety in that statement. I mention it often, particularly when I speak about gold, and I rather glibly say that if cycles are synchronized at their troughs, they cannot be synchronized at their peaks. That is because of the principle of harmonicity and the fact that the cycles that we are looking at here have mathematically related wavelengths. Because of the principle of harmonicity, if cycle troughs are synchronized, then their peaks cannot be synchronized. However, the fact that they cannot always be synchronized doesn't mean that they aren't often synchronized. It's an interesting subtlety. It's something I never really speak about, but it's certainly something to bear in mind. And so even when we are looking at an analysis of a stock market, for instance, where we do not expect the peaks to be synchronized, many of those peaks are, of course, synchronized, because a very big magnitude peak will indeed be synchronized across many cycles. And the same thing is true when it comes to gold. I have mentioned many times before that I believe that the peaks that influence the price of gold are synchronized at their peaks. Perhaps I should say more clearly that they are primarily synchronized at their peaks. Because of that, they are not always synchronized at their troughs. However, they often are, because of the fact that when a trough forms, it will often be the trough of multiple cycles. The important takeaway from this argument is that we focus more on the peaks when it comes to looking at the price of gold than we do on the troughs. However, there is often very useful information contained in the trough analysis, and indeed the combination of both a trough-based analysis and a peak-based analysis is a very useful one in my opinion. And so the current status of gold is that of course it is dropping out of an 18-month cycle peak. In very simple terms, we would expect the price of gold to drop out of the 18-month cycle peak and head down towards the next 18-month cycle trough, which you can see at the far right-hand side of this chart, which is expected sometime in 2023. When we zoom out in a moment, we can refine our understanding of when that 18-month cycle trough is expected. The important thing that I would like to point out is that in my discussion of the stock markets we've been looking at recently, we are also looking at a move that is heading down towards the 18-month cycle trough. Of course, there is a great deal of correlation between all financial markets. It is Hurst's principle of commonality. And it is very interesting to compare the analyses between these different markets. There is a widely held belief that when stock markets go up, gold goes down, and vice versa. And so when gold is going down, stock markets are going up. But of course, that is not the truth. There are periods of inverse correlation between gold and stock markets, but there are also many periods of direct correlation. And it is interesting to note that at the moment, the general price direction of gold, being downwards, is also the general price direction of stock markets around the world. One of the reasons that I thought it would be very interesting to take a look at gold today is because of this 40-week cycle trough. Bearing in mind everything I've already said about the fact that the peaks are synchronized and the troughs are not necessarily synchronized, there is useful information in this trough analysis. Here you can see I have pinned a trough of the 40-week cycle below this trough in the middle of May. And if you go and take a look at recent market updates about the stock markets, you will see that the middle of May was a possible time for the 40-week cycle trough in those markets as well. The interesting thing about what has happened to gold is that it has given us a little bit of a bounce, as you can see, and then it has dropped down lower. So I wanted to speak about this because it is something that often causes confusion when people are performing a Hurst cycles analysis. And that is the idea that when price bounces out of a 40-week cycle trough, we need to see a good deal of upward movement. One would imagine about 20 weeks of upward movement before the market turns down again. And the fact that the market has turned down so early might call into question the position of this trough. Indeed, it might. This might not be the 40-week cycle trough. But in situations of a bearish market, and this is a bearish market by virtue of the fact that the 18-month cycle peak lies behind us. And as I mentioned, the market is now moving from an 18-month cycle peak down into an 18-month cycle trough. Under those kinds of bearish conditions, we expect the bounce out of a trough, even a fairly big magnitude cycle trough, such as the 40-week trough, to be a disappointing affair. And so whereas it can be tempting to say, well, the fact that prices dropped down below this low in the middle of May means that the 40-week cycle trough must still lie ahead of us, very often the correct analysis is that the 40-week cycle trough does lie behind us, and all that we have experienced is ongoing bearishness. The reason why I think this is a particularly useful thing to bear in mind at the moment is because of the discussion that we had in last week's market update video about the S&P 500 and the formation of the 40-week cycle trough, which I do believe has now formed. And the fact that price has struggled to bounce up meaningfully out of that 40-week cycle trough does not mean the trough has not yet formed. It is more likely simply to indicate the ongoing bearishness following the formation of that 40-week cycle trough. So why do I think it is likely that the 40-week cycle trough has formed in gold? The first piece of evidence lies in the number of days that have elapsed since this 18-month cycle trough in August of last year. There have been 376 days. The average length of a 40-week cycle discovered by Hurst 50 years ago is 272 days. And so we are 64 days too long. That's quite long for a 40-week cycle. So that's the first piece of evidence. But in fact, a more important piece of evidence is the way in which the shorter cycles are breaking down. And that has to do with the position of this 20-week cycle trough, as you can see over here, and this 80-day cycle trough over here. Because those are very clear and well-defined troughs, I tend to have a greater confidence in this analysis, particularly in the position of this 80-day cycle trough and this 20-week cycle trough. This 80-day cycle trough over here was not very clear at all, being this very insignificant little price move down over here, but that is simply because price was rushing up into this 18-month cycle peak. And so when you see a good breakdown of the shorter cycles and a fairly good trough forming at about the time that we were expecting that trough to form, the chances are high, in my opinion, that the trough has indeed formed at that position. Another indication of a good clear analysis are these nests of lows, which you can see here for the 80-day cycle trough and the 20-week cycle trough. Those are very nice and clear, and as you can see, the circles are fairly well lined up above one another. That is another indication of clarity in the analysis, which probably means the analysis is fairly good. So let's slide this chart over a little bit and consider what we are expecting over the next several months for gold. First of all, here is that nest of lows for the 18-month cycle trough. And so that period of time in February next year is certainly a time that we should be standing by for the potential formation of an 18-month cycle trough. Here are the smaller and less important troughs, the 80-day cycle trough that we're coming into now, and then a 20-week cycle trough towards the end of September, perhaps early October. But as mentioned, the peak analysis is probably more reliable, and so what is happening in terms of peaks is this 20-week cycle peak over here, and then a rather staggered 40-week cycle peak that is occurring over here towards the end of this year or possibly early next year. How do we put that kind of information together? A very useful tool for doing that is to use our composite model line. That orange dashed line is the composite model line, which of course takes all of the information from the cycle analysis on the chart. It combines it and it produces in the past a record of how price would have moved if the only thing moving price had been the cycle analysis found on the chart. Moving into the future, it makes the assumption that the cycles are going to continue beating with the same rhythm, the same amplitude. And it will extend that into the future to give us an indication of what we should expect. Our expectation here is fairly clear. Price is now moving down into an 80-day cycle trough, which is expected to form in about the middle of July. Then it is going to bounce back up again into this 20-week cycle peak. Then price is going to move down into the 20-week cycle trough over here towards the end of September, perhaps early October. Then it is likely to move up, and here you will notice that there isn't a very clearly defined peak. Why is that? It's because of the fact that we have rather messy nests of highs over this period of time here, and so the cycle information becomes muddled. It's as simple as that. Does that mean that price is only going to give us a small bounce and then move down? Well, it might, but as we get closer to that time, the cycle picture is likely to become clearer. And as we have a clearer picture and more information about the cycles, we can indeed refine our projection. We have to be very careful of looking too far into the future. One of the dangers with these market update videos is that I tend to look many months into the future, and sometimes people come back many months later and they say, well, it didn't go exactly as you had drawn on your chart. The important thing, of course, is to remember to update your analysis and your expectations with each new piece of data. The important message, however, is that, of course, the price of gold is moving down from this peak of the 18-month cycle into this trough of the 18-month cycle expected in February of next year. What if you don't own anything in terms of gold, or you don't have any investment, either a long investment or a short investment in gold? What should you be doing now? Well, the most important thing, as I've mentioned, is that the price of gold is moving down. You could, of course, wait for this 80-day cycle trough and then possibly buy gold for a very short gain, but it is expected to be a short gain. More important would probably be to wait for this 20-week cycle peak to form. When that 20-week cycle peak forms, you would have an opportunity to go short for the rest of the move down into the 18-month cycle trough. But of course, choosing whether you're going to buy or sell and when you're going to do that has to do with the kind of time frame that you're interested in investing over, and it has to do with your own particular risk tolerance and other factors. And most importantly, when the moment comes for that 20-week cycle peak to form, you must, of course, update your analysis and update your expectations to see whether anything has changed. Finally, let's zoom in on this next 20-week cycle. And I would like to point out one final thing about the way in which you transfer your expectation of what is going to happen into actual trading information. The first thing to bear in mind is that the composite model line should not be taken too seriously, particularly in terms of price levels. I very rarely use the composite model line to go over and read a price level. That is because the composite model line is more reliable as an indicator of the structure of the market, as opposed to the actual price levels. The reason for that is because amplitude of cycles tends to vary greatly, and when the amplitude of the different cycles varies, the composite model line becomes fairly inaccurate in terms of its price level. However, it is very good at indicating the structure. What I mean is that the market is currently moving down. As you can see, it is expected to form a 20-day cycle trough at the moment, but it is moving down into an 80-day cycle trough. That is the first part of the structure of the move. The next part is a bounce up from that 80-day cycle trough into a 20-week cycle peak. Now that bounce up might be a much more impressive affair. We might witness a tremendous surge of bullishness, or it might be a very disappointing bounce up as it moves into the 20-week cycle peak. The important thing is to keep an eye on the time, keep an eye on the analysis, and anticipate the moment at which the 20-week cycle peak forms. Following that 20-week cycle peak, at the moment this analysis is telling us to expect a fairly strong move down into the next 20-week cycle peak expected at the end of September or early October. I do hope that you found this market update useful and interesting. I do think that there are many useful lessons to be learned by taking a look at a range of instruments and comparing the analysis between them. The Hurst cycles approach, or what we call the sentient approach to trading financial markets on the basis of Hurst cycles, doesn't differ markedly from one instrument to another. And so I do hope that these principles are beginning to make sense to you as we explore the ways in which Hurst cycles influence financial markets. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.